Thank you for your patience, everyone. We, thought we had our ducks in a row, but obviously, you can never be prepared for when technology decides it's going to give you a challenge. I'm going to look through some more of these questions and see if I can answer some of them. Narisha asks, what should my spending look like on my bank statements when I'm trying to buy a home? She uses her debit card for most of her transactions, such as bills and expenses and everyday items like food and entertainment. Is that looked at negatively? Again, Adrian can give you the expert perspective on that, but no, just using your debit card for your standard purchases. I mean, that's to be expected. That's what it's there for. That's what it should be used for. So that's not going to have a negative effect on you. Let's see, let me scroll down. Best way to increase your credit score. I can take a crack at that one. You definitely want to make sure you're making your debt payments on time, whatever that may be, a car loan, personal loan, if you owe medical bills, student loans, whatever they are, anything that you have that's an active account, you need to make those payments on time. And having a good payment history will benefit you and strengthen your credit score. Another thing you can do if you have low credit, because you do not have very many credit accounts, you could look at getting a credit card, one with a small balance, and use that for small purchases and make sure that you pay the balance off every month when it's due. If you can use it to have one that gives you perks like mileage for airline miles or cash back for gas and groceries, or any of these, you've seen all these credit cards that have different incentive programs. Use it for, some small level of expenses. And then if you spend $200, make sure you can pay that $200 back when the bill is due each month. And that will help you to build a healthy credit habit and credit history and payment history, which will positively impact your credit score. A lot of times people think that having a credit card period is a bad thing. It's not. When it becomes bad is when you don't use it responsibly and aren't able to pay your balances off on incrementally when they're due. Then you have a late balance, or you've used up all of your credit allowance. If you have a credit card with a $2,000 allowance, and you spend the whole $2,000, and then every month you only make your minimum payment back, whether it's $25 or whatever it may be, then you have a high level of credit usage, and that looks bad on your credit score. So if the limit's $2,000, spend your couple hundred or whatever you need to spend, or spend the whole $2,000, but make sure that when the bill comes due, that you're able to pay that back. And I think we have Adrian. Adrian, go ahead and speak.
There we go. Can you hear me now?
Yes, we can.
Perfect.
Okay, we're back in business, guys.
Back in business, and can you see me okay as well?
Yeah, this is good. So make sure you mute the one on your computer.
I turned off the audio on it, so we should be good on it. All right. Okay.
Okay, so we're ready to cook. Let me get back to.
We're ready to rock and roll.
We're starting from scratch, Adrian, because I don't think that we were able to ever hear you consistently from the beginning. So we're just going to start right here.
Okay. All right then. Now I'll just turn off this one. Let's see. All right. Well, let's go ahead and start over again. We'll start with the financing key terms. Apologize about all the technical difficulty and so forth. But we definitely want to make sure that everyone understands the lending process itself and understands clearly what a first-time home buyer is. We have to clarify what that is. So first and foremost, we want to make sure that you understand that a first-time home buyer, who is it? It's someone who has not held ownership in a property nor property title interest in the last 3 years. So if you owned a property 10 years ago or 20 years ago and went back in or fell upon hard times or decided, well, I want to go back to renting, and you're just now looking back into the market again, you are classified as a first-time home buyer. So regardless of if you've owned homes many years ago, Within the 3-year period of time, if you haven't owned the property or co-signed for anybody to own a property, you are classified as a first-time home buyer. Another step in the overall process, because ultimately there were some questions that came through asking, when should I begin? The best time to begin the process is as soon as possible. I can't stress that enough. And when I speak of beginning the process as soon as possible, that means knowing your financial situation, knowing where your credit score is, what you have in your credit. That information is key to being able to move to the next phase in each step of the way towards home ownership. So once you understand your financial situation, next is to sit down with a consultant, someone who can review your financial overall scenario. And in many instances, that's why individuals go to lenders like myself. They want to understand, can I qualify to purchase a home? Yes, it may entail a credit pool, but that credit pool gives us a big picture, and we'll talk a little bit more about credits as we move through today's slide presentation. But the credit pool gives us enough oversight on how your payment history has been. And it's one key factor, but not the only key factor to becoming qualified to buy a home. So as you can see there, there's the step, pre-qualification. Many times individuals ask the questions when they're going to meet with a lender or a consultant, should I go ahead and get a pre-qualification? Well, pre-qualification is just a casual review of your overall credit and your application that you may have provided over to the lender. It is not a solid, definitive answer that you're guaranteed to be able to purchase a home. The pre-approval, on the other hand, is more of an in-depth review of your credit, your income, your assets, and other documentation that's obtained at initial application. So when we sit down and we do that financial overview and we look at your financial situation, we're looking at the big picture. We've got documentation to back up whatever we put on that application. That comes in the pre-approval process. Not only with that, it also has what's called an automated underwriting system analysis that's conducted at that time. That finding report allows us to determine which types of products and programs do you meet the rules and regulations for their guidelines to proceed to the next phase in the process. Keep in mind, you don't get your interest rates all up front there because interest rates change daily. They're tied to the economy. So that's the first stage of the overall lending process. There's a second stage. Once we pass the hurdles as far as being able to get through the pre-approval, we need to find a home. Those pre-approval letters are provided over to your realtor and also to you so that you can go ahead and begin the overall search for a property. With that, this second step is the process where we receive a location or a property that you selected, you went under contract, and now we move on to what's called a conditional approval. That's where the lender will actually come through and issue what's called a lender commitment based on an underwriter reviewing it. The analogy I use a lot in presentation is we're the attorney. The mortgage lending officer is your attorney. And we present your case and build your case, present it to the judge or the jury, the person who makes the ultimate decision, which is the underwriter. They are the ones that issue that lender's commitment. A third stage in that overall lending process, once the underwriter issues that and they review all the documentation together, is a final approval process. And this is where you're able to, the underwriter may have requested throughout the process, the lending process, additional documentation because they were uncertain of particular areas in the overall documentation. And they had to support it to keep the case file moving forward. But the final approval, which is our third stage in the process, is where they've received all items needed in order to get you to a clear to close, or what we call to become a new homeowner. Those are the three stages in the overall lending process that you will go through. Now, I put on here also debt to income. Why did I put that on here? Well, I saw a few questions come across in regards to what is debt to income. These are ratios based on what the expectation is for that new home, what the housing expense ratio will be. And the housing expense ratio is what we call an upfront ratio. And this is determined by several different factors. And it's very important that we understand what a housing ratio is. This upfront monthly housing expense that you anticipate on this new home you're purchasing in determines exactly what our purchasing or our buying power can be, along with the other ratios, okay? What happens is we take the maximum qualifying amount that you can, that you're eligible for principal, interest, property taxes on that property that you're looking at, the insurance, the homeowner's insurance you're going to take out on the property. And we also look to see if there's any association due. This is what we call as our upfront monthly obligation that we're going to take out, or prospective obligation. We divide that by what's called your gross income and your gross monthly income. And that is not that take-home pay after taxes. It's pre-tax dollars that you have on that pay stub, or you may have in the business itself to help you qualify for the loan. When we take that total prospective amount up front of what expense will be for this mortgage, we divide it by that gross income. That is what is called the housing expense ratio, or your upfront ratio. So that's one hurdle that we go through for qualifying individuals on the debt to income ratio. Often, some people may exceed that dollar amount. So there's a second avenue that we look at, and that is called your total debt to income ratio. Now, the total debt to income ratios is that housing expense ratio that's anticipated, but it also incorporates in what is called your credit obligations, what showed up on the credit report as a monthly obligation. So in this example, you'll take the total credit monthly debt obligations that are on there. Now, if you have student loans that are in deferment, only in certain types of products and programs will those student loans be qualified to be deferred if they're income-based related. If they're not, deferment, forbearance, due to COVID-19 or any other situation, 1% of your total student loan debt has to be calculated as a monthly expense, unless you can provide documentation that shows what the true monthly expense should be. So we add that to your housing expense ratio. When we add that to your housing expense ratio, we're then going to go in and divide that by your gross monthly income. Now, so that you can take notes on this, housing expense ratios, when they come to a conventional lending process, this is not your typical outside of the box type lending, conventional lending process, rule of thumb, you want to use roughly about 38 to 48%, okay? 38% on conventional, excuse me, 38% on conventional. If you're dealing with the total debt to income ratios, maximum allowed, okay? And this is the one that we most often go off of. On a conventional loan, is 43 to 45%. On a government loan such as FHA, maximum allowable amount is up to 55%. If you're doing a VA loan, it's up to 41%. So the banks are are heavily regulated, and they have to make sure that it's a benefit to you as a consumer, especially with all the changes over the last 2 decades, okay? With that being said, what is the automated underwriting system analysis? Well, this is made up by our conventional agencies such as Fannie Mae and Freddie Mac. They have these systems that we actually input your application through, along with income, your asset, and your credit information. It then provides us with a finding report that tells us, here's the documentation that you should have in the file, and if you don't have it in the file, you will need to request this to proceed to the next stage in this lending process. Next slide. So once we move to that next stage in the lending process, we want to make sure that we understand truly what is credit, because everybody talks about, oh, my credit score is X amount, so I want to make sure that I get the best interest rate out there. Well, And the next door neighbor may have the same exact credit score as you, but guess what? Their financial situation is in a different arena than where your financial situation could be. They may be receiving gift funds from family members, whereas our family members may not be providing us with gift funds. They may be involved in other types of employment situations that provide them additional supporting income. So credit score, do not base your qualifying just based on the credit score. It's based on all documentation. So the best way to do this is start putting together your security bag or your file cap so that you can turn around and have certain documentation set aside. And we'll talk about that as we move along. But with the credit score, it's not the only qualifying factor for the lending process. Fair Isaac Corporation is the one that we use frequently on the lending and banking side. Vantage, which is done through Credit Karma, is not the overall tier level or factor that we're using to qualify individuals. And in many instances, you will see there is a dramatic difference between Credit Karma and the Fair Isaac FICO scores. And I want to make sure that's very clear. Under Fair Isaac, okay, or the FICO score, there's 3 primary credit bureaus that we receive this information from outside of Vantage, okay, which is Credit Karma altogether. So we'll take Credit Karma out of the picture. We look at Experian, we look at Equifax, we look at TransUnion. They all have websites out there that you can always go to. Experian actually has a means for you to be able to boost your credit score as well by self-reporting. This is a factor you may want to check into, or if you need additional information, feel free to reach out and I'll be more than happy to share that with you. But these are the 3 primary credit bureaus that all banks and lenders use. Now, we go through credit vendors. And so you may see a difference when you go from one bank to another bank or to a mortgage lending house. You may see a variance in the credit score. Also, another factor is when that credit score was pulled, whether or not your particular credit card company or your automobile company updated the credit bureau when we actually went in to pull it. If we pull the credit report, let's say on the 15th of the month, and your credit card company does not send their reports for 100 million clients until the 20th of the month, guess what? It's not going to show you current on that credit. So your credit score may dip a little bit. Keep that in mind when you're looking at it. Now, when banks look at these 3 primary credit bureaus, we look at the middle of those 3 scores to be fair to you. Some scores may show 750, some scores may show 720, some may show 700. We go with the 720, which is the middle credit score, because we're not going to go with the high one, we're not going to go with the low one, but we're going to hit you right in between the middle. So the middle of these 3 credit bureaus is the one that will be used and figured in as a credit factor, okay? How is the credit viewed by lenders? So I think if you hit the slide one more time, there should be a queue up of a box there. I think yeah, and a few more. Yeah, it's starting to come through. There we go. Yes, that's what I wanted to look at. So let's talk about several variables or factors that make up the credit report. The thing is you have your payment history that represents roughly about 35% of your overall credit score rating. That's how do I pay my bills over time. Many times individuals look at turning around and saying, hey, listen, I'm going to turn around and I got this old credit card that I haven't used in a long time or in the last few months, and it's just been around for 10, 20 years. So what you can do is you can turn around, and some people try to pay that off, but it's not always to your advantage. As you can see, the payment history represents 35% of your overall credit scoring factor. What about my debt? Well, your debt represents 30% of that factor. So depending on how much debt you have consumed inside the credit report, it will impact overall. So that's 65% that's really hitting your credit score. So those are things that you want to pay special attention to when you look at that credit report. Your credit history, what's the standing of that credit history? 15% of it. So If you have a history, you want to also keep that in mind. New credit. If I go and take out new credit, it's just starting. So it really hasn't had a chance to really build up a history, a payment history, or establish some sort of credit history. Typically on new credit, you need to have it on there for at least 6 to 12 months before you start to see your credit score start to go up versus going down. So new credit can turn around and impact and lower your credit or credit score itself. Types of credit. There is a difference between having an installment loan and having a revolving credit card debt. Why? Because those revolving credit card debts can always be used, whereas an installment loan has an end period. It has a closeout period of when it can be paid off. Same as with a mortgage. So that represents 10% of your overall credit score factors. What happens is the lenders, when they look at this, here's how they actually look at your credit. You may see other models out there, but this is what lenders look at, what Fannie Mae, Freddie Mac, and also government lending looked at as well. So if you're at below a 620 credit score, it's less than stellar, okay? That's where you have to work on that. And that's why when you sit down, you have the credit pulled, or you can either go to a consumer debt counselor or some sort of credit management company. They will be able to assist you in being able to work on that credit score. Once you get it up, just based on the soft credit pull, once you get the credit score up to a 620, that's where we can come into the picture and start to help you look at different alternatives and agencies. 620 to 719 is good credit score. 720 or higher, that's excellent credit score, okay? So please keep those tiers in mind when you're actually looking at credit score, okay? Now, let's talk about the minimum required document to start the overall lending process. Here's what you want to start gathering together. Create a file folder for yourself. That way, you know your goal is to buy into a home or to become a new homeowner, find that future home there. You want to have your income docs set aside. What are needed with income documentation? Well, you need your most recent 30 days of pay stubs when you're sitting down with the lender for the overall financial review. 2 years of tax information, personal. If you own a business, you need 2 years of the business tax return. And depending on what type of business, those are things that we can talk about. But that information is vital to the overall income review process. And then W-2, 2 years of W-2s. Make sure you have everything that made up your income bracket. So once you do that, you file that into your income section of your file cabinet or your briefcase. Next is asset. At least 60 days of bank statements. They want to see 2 months seasoning on the bank statements, at least when they're coming to a lending. And that is minimum required documentation to start the process. With that, all pages of the bank statement. Often I see some of the times may have page 404, and because it was blank, it gets omitted. So we only got 3 or 4, and 404 is missing. Have all pages of your bank statements there readily available. Okay, 2 months. Government ID is something that is vital to the overall process, based on the fact that the Patriot Act, many of us can recall back to September 11th, 9/11, right? Well, with 9/11, the Patriot Act came into play. So now it is a requirement that government IDs be also included in any documents that prior to moving forward on any lending process, and any other supporting documents that we can think of. Okay. So with that being in mind, I want to pause there for a brief moment. I know we've considered a few factors that impact the overall start in the lending process, or we're either getting prepared for this journey towards home ownership. Let's poll the audience a little bit on some of these questions that we may have sent before. So let's start with one of the questions in regards to lenders use what 3 common credit bureaus to qualify an applicant. Okay, so I'll give you a pause for a moment and let's get some active audience engagement on this. Lenders use what 3 common credit bureaus to qualify an applicant?
I went to the next slide so they wouldn't have an answer.
Okay, okay, good, 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 good. No problem. All right, I'm seeing some answers come up, and I'm liking the answers that we're getting. So the best way, all right,
Do you want me to end the poll now?
let's go ahead and close out that poll.
Okay.
And let's see where the majority fell at. Where did they fall at? Perfect. Okay, 69% of you said Experian, Equifax, and TransUnion. You're exactly correct. Credit Karma is out of the picture on this, okay? Vantage, which is Credit Karma's scoring model, is out of the picture on this. It is Equifax, Experian, and TransUnion, which uses a completely entire different scoring model that lenders work with. Thank you very much for your participation. I appreciate that. So those are things that we look at when we look at the overall process. Let's ask another question. I'm curious to say, question number 2, which letter is the best when looking for a home? Let's ask that question. Which letter is the best when looking for a home? Let's get some more active audience engagement there. We'll give you a few seconds on this. Now, keep in mind, there is a difference between the two. And often in the industry, these are so commonly issued, pre-qualifications are so commonly issued, but are they the best when I'm looking for a home?
There's about 65% who voted. Anyone else is going to vote?
Yeah.
You want me to end the poll?
Let's end the poll. Let's see where we're at right now. And survey says 81% of you got it exactly correct. I appreciate that. Pre-approval letter is what you need. Often pre-qualification is they use it way too frequently out there. You go to, let's say, for example, a very large bank, they issue a pre-qualification. You take that pre-qualification. It is not a guarantee that you're approved for a loan, nor is it a guarantee that you're even ready for the loan itself. It's best to have a pre-approval in process, okay? So if we could go back to the next slide, I just want to sort of touch just the final part of that past slide. And we'll go from there. And thank you very much for, okay, excellent, excellent. So a couple of things that we wanted to touch on this slide would be the property appraisal of future home versus home inspection. There is a difference, and I use the analogy, and I love using analogies whenever I do these types of communications. The difference between an appraisal and a home inspection. Think of an automobile. I'm going to purchase an automobile. Man, this automobile looks real nice on the outside, cosmetically, everything's looking good. It has that marketability. It's got some nice tires on it. It's all shined up, done up nicely. Well, that's your appraisal. That's how it comes into play for the future home itself. You're looking at the appraisal is based off of current market marketability of your house, the collateral. And it's not in a 5-mile category. Especially if you're in a local metropolitan area, it's within half a mile of that house. And it's based on the community and the subdivision. The same as the automobiles. It's based on the style and type of that automobile. However, a home inspection, on the other hand, is the technician or the mechanic that's underneath the hood of that car. He's got to make for sure that engine turns over when you crank that car up. That's the home inspector. So when he goes in and he actually looks at your home, he's looking at the bells and whistles. Is the electrical working well? Roof, is the air condition operating correctly? He's looking at the things that make the house functionable, similar to an automobile. So that is the difference between an appraisal and a home inspection. Some of the times it may get confused, but these two things are completely separate, and they're handled through third-party outside services that are rendered. And then you have the settlement agent. This is the one who's actually going to hold on to the money and make sure it's executed to provide you with a clear title and make sure that the monies are accounted for appropriately when you get ready to go to a close. Okay? So let's go to the next slide there. So let's talk about some financing key terms. A couple of things you want to know in regards to 4 common mistakes that you want to avoid. Number 1, job status change. Changing jobs during the middle of your lending process can interrupt or disrupt disrupt how things are going to move forward. It could also disqualify you from being able to get the loan at the end stage, and you're midway through. So changing job status is something that you want to reach out to a lending consultant like myself, or the person who's working on your loan, to make sure that, is my job status change going to impact me? It may be more money, but it could impact you, especially if it's in a different industry altogether, or you're going to become self-employed versus making a regular wages. Okay, so please keep that in mind. Job status, number 1. Mistake to avoid, number 2, is late or missed payments on your credit obligations. Keep in mind, the lenders will pull at closer towards the end. Once you get towards the closing, a soft credit pull to make sure nothing else has changed in that credit history. Any new obligations or falling behind on credit could cause your credit score to lower, and that could put you into a different category. Remember, we gave the different tiers on those credit scores from excellent, good to less than stellar. If you are borderline, it could put you at less than stellar, which could interrupt the overall process. Number 3, applying for new credit. Anytime you go out and apply for new credit while you're in the middle of a lending process is a no good scenario. Why? Because it's going to raise a lot of red flags that the underwriter, our courtroom judge, is going to have to decide on, and they're going to ask for more information. If that new credit takes you into a new obligation, now you've got that payment that's factored into your ratios, which reduces your purchasing power, or could overall put your ratios too high to where you're ineligible now for that particular loan. Taking on new debt, same scenario there. That is number 4. So these 4 mistakes you want to avoid altogether. If any of these you're thinking about or contemplating, please, the first phone call, first reach out or conversation you should have is with your mortgage loan consultant. Now, let's talk about the common types of mortgages. We have conventional and we have government. These are the most common ones. There are more types of mortgages out there, mortgage types of loans, but we're just covering conventional and government because those are the ones that go in line with the Assistance Down Payment Program. So you have Fannie Mae and Freddie Mac. Many of us have heard those terms, but what does it mean to me? Well, they fall into a conventional category to where the lenders will offer these, and many times they'll have variants, specialty products that surround Fannie and Freddie Mae. Did you know that Fannie Mae and Freddie Mac now offer as little as 3% down? Well, if you didn't, it's there. Did you know also that Fannie Mae and Freddie Mac turns around and allows over a period of time your mortgage insurance to no longer exist? Did you know that on Fannie Mae and Freddie Mac, you can buy out the mortgage insurance and with more than if you don't put more than 20% down? See, often the concept is that if I'm going conventional, I got to put 20% down to avoid what's called mortgage insurance. No, you do not. There's creative ways to be able to do that. Want to learn more? You can reach out and we can talk about that further. But yes, these programs do exist, and they do have specialty programs for first-time homebuyers. So that's the conventional avenue. Then you have the government avenue. Many of us are familiar with Federal Housing Administration, also known as FHA. Okay, this one, 3.5% down. This was back in the 90s when this came out. It started to help a lot of first-time home buyers right around the 90s. People were really loving FHA products. They were HUD home. Oh, I could get into a HUD home and get this special benefit. Yes, those were common. They're government-backed, which means that mortgage insurance is a requirement. Prior to 2018, many individuals heard that FHA was doing away with mortgage insurance. Yes, they did for a short period of time, but now it's back. Mortgage insurance for the life of the loan. Okay, so please keep that in mind for FHA. Okay, U.S. Department of Agriculture and Rural Development is your USDA loan. So that's typically for those market areas that are zoned agricultural. So you go out to Polk County, Lake County, or counties where it's real rural, and you have properties that are sitting on 2 to 5 acres, yes. Or subdivisions that are close by in those particular classified USDA areas, you can qualify for USDA loan up to 100% financing. What does that mean? No money down, but it does not mean there's no closing costs or settlement charges that will come into play. So please keep that in mind. Everything above and beyond the purchase of the house, there are certain costs for recording fees, as well as also taxes and stamps that go along with the overall transaction. Then you have your VA loan or Veterans Affairs type loan. This one is 100% financing as well. Through Iberia Bank, we have no lender fee. So with the VA type loan, you can qualify for that as long as you have that certificate of eligibility, which is needed, showing what your entitlement is. Okay, there's more surrounding VA loans that are available out there, and many people should be taking advantage of what they receive from the federal government as benefit. But those government loans are backed or insured by the federal government up to a certain dollar amount. Okay, next slide. So let's talk about down payment assistance. Okay, let's ask the polling question before we get into this, because I know a lot of people are they're eager and they're anticipating what's available out there. So let's talk about, let's pull up polling question number 3 for the audience. Okay, am I automatically guaranteed a loan financing if I'm pre-approved? So I'll give you a few moments while you're doing that. Think about it. I'm going to sit with somebody to learn about my financial situation to see what they can do. But are they the ones that guarantee or make the final decision on my loan? Or are they just that case builder for me to put my information together and see what's eligible out there that I could fit into? Am I automatically guaranteed loan financing if pre-approved? And where are we at on the audience participation engagement?
We are at 61%.
61, okay. Once we reach 65, we can go ahead and we'll close it out and then turn around and share the results.
Okay, we're there.
All right, awesome. And survey says no. And you know what? That's exactly true. No, you are not guaranteed a loan. Is anything in life guaranteed outside of death and taxes? No. So definitely thank you very much for your participation in that. Now let's talk about down payment assistance, okay? Because we've talked about the lending overall process. Now we're going to talk about down payment assistance and what it's all about. Well, understanding what is available out there in assistance. Well, you have your gift fund. So as you can see, I put together a little chart here where it talks about gift funds. What are gift funds? Well, the gifts are what you receive from a family member who's not related to the overall transaction, but related to you. Cousin, brother, sister, mother, father-in-law. These are gift loans, typically follow up with documentation. And they do not have to be paid back. The gift is not something where you give it to someone and you say, hey, listen, I want to get some compensation back. This has to truly be something that's given to you without any return or recourse, okay? Grant funds. Now, we've heard of a lot of grant funds out there. So let's talk about those. They do fall into a no lien is created against the property depending on who the agency is and who the lender is. Now, there are certain grant funds that potentially could put a lien on there, and we'll talk about those in the government assistance side of it. But they're not a loan, so there's no repayment. I get those free, I get the grant money, it's free, it's to me. And can it be coupled in with other down payment assistance programs? Yes, it can. It can be stacked. Iberia Bank has about 3 or 4 of them that we offer out there. Now, you do have to meet certain qualification requirements in order to receive those benefits. But, you know, it's something that is available and that any lending officer should be looking at as an alternative to help you get into the home. I just got done closing a loan today. The county was unable to come up, or the consumer was unable to be eligible for the county assistance program. We were able to get them plenty of grant funds coupled together with some additional assistance. And guess what? They were able to close on the house appropriately and still met their expectations. There's no recapture. You don't have to give back a grant, similar to like a gift. Now, let's move over into the category that we're going to move into next, which is talking about where liens are created. These are government assistance funds, bond funds, and affordable seconds. These all come from different types of agencies. It can be a local agency. It can be a nonprofit organization that says, hey, listen, as a first-time home buyer, if you're in this house for this X amount of period of time, we'll let you be free and clear of owing us any of this money back. So there is a second lien created or a second mortgage created on your house, okay? It's provided typically by a local agency, which is government or backed, or either a nonprofit can also do that as well. They can be forgivable or repayable. And the reason why I make that clarity there is not all bond assistance or government assistance programs mean that you don't have to repay it back. They do place in their special recapture clauses that say you take out $10,000, you decide you want to sell this house, you want to rent this house, you want to rent a room out in the house, or you want to refinance the house, you could turn around and be obligated to actually have to pay that back. But that's not a bad thing, because most individuals are in their house for 3 to 5 years or 5 to 7 years before they do any of this type of overall transition, which means the grant or the bond funds can be to your advantage, okay? So let's talk a little bit more on the next slide about Orange County. I believe that's Orange County is the next one that we have in the slide. Yes, our favorite one, Orange County down payment assistance. Now, a couple of things that you want to know about Orange County down payment assistance is one, the purchase price of a home cannot exceed $230,000. And the home itself cannot be in the city of Orlando, because the city of Orlando has their own assistance program. But with Orange County, surrounding areas, all the way out to Ocoee, you've got some parts of Apopka, all over Orlando that's in Orange County related. As long as that house is under $230,000, purchase new or existing, you're eligible to see if you qualify for the down payment assistance from them. They offer up to $35,000 in assistance based on where your income is, and not just your income, but household income. If I have my mother living with me, or if I have my mother and a husband or wife living with me, then guess what? My significant other's income, all of that has to be calculated in. What about a child who's age 16 working at this time? They're considered to be part of the household. Their income must also be included in there as well. This is available on all types, the majority of the types of properties that are out there, except for mobile homes. You've got to attend HUD certified homebuyer educational workshop to receive these benefits, and it has to be your primary residence. Now, one thing that I do like to mention on this as well is there is some skin in the game. Nothing in life is free. We did have a question earlier about some of those programs back in the day, and I know early 2000s, they had a ton of them in the subprime market, the hard equity markets themselves, where you could go above and beyond the purchase price of the house to be able to get a loan and not have to come to the table with anything. Since 2010 or since 2008 mortgage meltdown, that's changed. A lot harder guidelines, more stringent, because the banks had a lot of homes that went foreclosed on. People abandoned them, went back to other countries, and just said, "Hey, listen, I got all this, got this home. and I don't need to pay on it, I'll just leave it because I didn't put no money into it. Well, the banks cannot take on that obligation. Many of them went out of business over that. So now there's harder guidelines that are now heavily federally regulated, okay? So 1.75% of what the purchase price is, or either $1,000, whichever is the greater of the two, is required by Orange County. And they will identify that that money has to be your funds vested into this product. Skin in the game, okay? 620 or higher credit score. It has to be that good credit score. And you come to the lender first, okay? Once we get through our conditional and lender commitment process, and we have an appraisal conducted on the property, which is a third-party service, as well as also the home inspection and the termite inspection cleared, and then we fill out the application for Orange County. At that point, then we can submit it over to Orange County. Often you'll hear that it takes 45 to 60 days. That is the reason why. You have to go through one stage first before you get to the next stage. Now, what happens with that is many individuals may not be aware that right now there's a moratorium in all counties in the state of Florida. What is a moratorium? That means a frozen assistance fund, which means that they're not taking new applications right now. Orange County stopped August 14th. They've reallocated those funds towards the CARE Act or the CARE funds or the COVID relief fund to help out homeowners or individuals who are renting right now with additional assistance. So right now there's a freeze on it. When it will be back, we don't know. It could, as long as coronavirus stays around and it continues to put this strain on our economy, on our citizens themselves, what's going to happen is we may not see it for the next 2 to 3 months. So what alternatives are there? Well, let's move to the next slide. Okay, this one's just a little bit more information on the down payment assistance, some of what I went through already. So one more slide forward. This just talks about a complete assistance package is necessary and you come to us first. More information on these county programs is out there on the Orange County Housing website. So that same flyer, you can dive deeper into it and find out more. So no, back to the other one. Back to the other one real quick for me. The one before that, because I do want to touch on the bond fund. And why I want to touch on the bond fund is because though the local county areas have placed a freeze on accepting new applications, there is still available over $57 million in Florida bond money sitting out there. What does that mean? Well, that means that we can go to the state of Florida and you'll still come through the lender. We'll reserve those bond funds, have them set aside for you, up to $7,500 or up to $10,000. You've got to meet their household income requirements for whatever target market or non-targeted county area you live in. This covers the entire state of Florida, not just Orange County. So if you're going to Marion County, you still are eligible for some of these funds as well. Cannot exceed the maximum purchase price amount, and they base it on the county area or the target market area as well. With this one, it's a little different than most local county agencies where you can have a 620, where we take a 620 credit score. Conventional, you have to have a 640, and for FHA, you have to have a 660 credit score. And the maximum allowable debt to income ratios cannot exceed 45%, okay? And you have to be classified as a first-time homebuyer and intend to work shop where you're HUD certified. Now, with the different programs there, with the Florida Bond Assistance Programs, you can get up to $7,500. That is deferred second mortgage that's going to be associated with the property for a 30-year period of time. So as long as you live in the house, you'll have that deferment on there. If you get to $10,000, then of course that one itself is going to be based off of 3% over a 15-year second mortgage. So you'll have a second payment associated with your first mortgage payment, okay? So this is the bond fund, the state of Florida's bond fund that is readily available for all of you that are on this call today. Okay. Now, one other thing I did want to mention on the county assistance programs is they also have certain requirements when it comes to uh, um, maximum DTIs, and it varies according to which county you go into. So please keep that in mind. Seminole County has a 259, and then they allow you to go to 239 on existing homes, 259 on new construction homes. When you're in Lake County, it's 180 is the maximum amount that you can get in there. And that is for your most local county assistance funds. Each one's different, so when you find a property, that's when we can sit down and see what's eligible for you to provide you with assistance. A lot of times people ask for this right out the gate, and it depends on where you're at, where your property's at. It's really, you know, if you decide to go, let's say, for example, the Winter Park. And some of us are familiar with Winter Park. Winter Park has two counties, Seminole and Orange County. Which one are you going into? Because that can determine exactly what size or the amount of household income, how much assistance I can receive. So really the best way to find out about assistance programs is when you've actually found a house. If you're getting pre-qualified, get pre-qualified. But if there's any changes to the assistance programs or where you're looking at moving at, notify your lender immediately. And all letters that the lender uses should identify if you're receiving down payment assistance. So get two pre-approval letters, one with assistance and one without assistance. That way you have a good range as far as where you can fall into play at. Now let's talk about some free money, money you don't have to pay back. It's called grant funds. Let's move to the next one. Yes. And so there are grant funds available. We offer up to $4,000 based on the affordable market area. And the zip code that Antoinette had actually mentioned earlier for that particular market area, it does qualify for many of these assistance programs. We just got to make for sure it's one or the other, anywhere from $2,000 to $4,000 on our what's called our ISP grant program. Then we have a first responders program. And this can allow you eligibility up to $5,000 in grant funds. And this can be stacked on top of the bond assistance program or the local county assistance program as well. With the first responder program for our heroes in the communities, if you're in the field as far as a first responder, you can actually qualify for up to $5,000 based on where meeting the area median income for that particular local area, $3,000 to $5,000. You can be a military, you can be a firefighter, you can be a policeman. That all falls up under first responder. If you work for the fire department as a janitor, or you work for the police department or the military in desk operation or call center, you can qualify for this particular program under the First Responder Heroes program. What about education? What about our school cafeteria workers? They can qualify for the First Responder program. We weigh out which program is going to give them the most bang for their buck. And so whichever one's going to give you the most money, you can qualify for that. But it goes down even to the janitors in the school system. It has to be an accredited school, but the educational system can receive benefit or additional assistance when they qualify for a loan. And what about those that are in the medical profession? I may sit as a payment collection for a medical collector and so forth. You can qualify for this. You may sit at the front desk as the registration desk. You can qualify for this. So there's many individuals that have opportunities out there that may be in these related fields, may be in a certain local area, may meet a certain income area that can qualify for the $4,000 or the $5,000 grant programs that are you don't have to pay them back. Now, one other program is that no money down home start program. Of course, there is a credit score requirement of 680 or higher, but if you have less than that, you can still qualify with as little as 3% down. Can I use these grant programs with the Home Start program? Yes, you can. So let's say, for example, I've had a couple of individuals who turned around I just closed a few who were in the Home Start program. Okay, they qualified for it, 730 credit score. They went to the closing table, no money down. Okay, now, of course, they had their closing costs and they had other expectations on that as well for services that were rendered above and beyond outside of the actual purchase of the home. Well, I used one of the grant programs and got them an additional $1,000 to apply towards their closing costs and settlement. Then if the seller contributes, which they can, up to 3% on this particular program, how much money do I need to have stake in the game on this? $500 is all you need for the Home Start program, if you meet those parameters. Now, I'm not saying that every one of us that are on this line right now can meet those parameters, but it's worth a look, okay? For more information on how to structure it, feel free to reach out, okay? So let's put up, let's see, I think we have one more slide after this or not, do we? Before we go to the case scenario, let's do this. Let's go to poll question number 4. Let's go to poll question number 4. All right, so once again, you get that opportunity. And here's survey number 4. Am I automatically guaranteed down payment assistance if the lender approves the loan finance? Am I automatically guaranteed that down payment assistance if the lender approves the loan finance? And think about that. I had a similar question before on that. And remember, this is more than just a one-stage process. Lender approves it, you also have to go through certain other eligibility requirements. So let's see what the audience is. Where are we at on poll numbers? Are we at the 65 mark?
Not yet. You're at 60. You need a couple more of you to vote.
All right. Hope I ain't putting nobody to sleep out there. All right.
We're
awesome.
at the 65.
Excellent. So let's see what the survey finally reads. Awesome. We got 100% on that. Everybody deserves a round of applause on that, okay? And it's perfect that you remember that. Keep that in mind. Nothing is guaranteed out there, but you're doing a fabulous job. And thank you very much for engaging me with this particular feedback, okay? So let's look at case study number 1 as we move forward. And we'll just briefly peruse through these. These go into detail a little bit more. As far as we have a proposed home ready product, okay? Now, home ready, just for clarification, is a Fannie Mae specialty program. Every single lender, every single mortgage house offers it, okay? Because it's part of Fannie Mae, which is that conventional lending opportunity. Now, you have a 640 minimum credit score, 43% debt to income ratio. And at 43%, can I go a little bit higher than that on home ready? Our automated underwriting system or analysis will turn around and actually provide us findings and feedback. And in many cases, you may qualify for the home ready product and may have only been going just for the convention, okay? But you have 3% down on a single family resident. How would that look in a scenario? Okay.
Real quick, Adrian, I'm gonna shoot to the preview of this property. This is the one that is actually currently on the market at 548 Laverne Drive. So I wanted people to be able to see the quality of home that you would be getting at this price over here in West Lakes.
Okay, sounds like a plan.
As you can see, this home has been renovated. It's got some nice features there. Mm-hmm. Got stone countertop, fresh paint everywhere, new cabinets and floors. Got that open concept living room into the dining and kitchen area. A lot of people like that. That's kind of a newer trend now. You know, older homes, you have everything all blocked off, more walls. These days, people do like the open concept. Cancel that music. Okay, so now to the numbers. So this first screen here, this is a closing cost estimate, and this is something I calculated through local title company, the closing agent. Adrian mentioned earlier that is kind of your third party. That's the keeper of all the money, the third party that makes sure all the money gets exchanged properly, make sure your title is clear, does your lien search, and checks out all of the dots all the I's and crosses all the T's. So on this home at 249.9, you'll be looking at 10,000 due at closing. That's going to include down payment of about $7,500. That's your 3%. Lender fees of about $1,900, and then you have title and escrow fee that you have to pay for the title company services. And then there are some recording and transfer fees that you have to pay. That's including fees that are due to the county for you actually purchasing the home. And so then at the end of the day, again, that's going to come to closing costs of $10,000 as far as title is concerned. And then we'll look at this worksheet that Adrian has prepared to give you a little more clarity on what some of those fees would be from a lender perspective.
Excellent, excellent. Thank you very much. I appreciate it. So with that being said, what you're looking at is here at our particular company, and each company differs, you may find what's called junk fees out there. So a couple of things that you want to focus your eyes on is item number 800, I believe it is. Section 800 on there. I can't see that too well. Let me maximize my screen a little bit. There we go. Yes, item number 800, or section 800, which is to the top right-hand section or columns. That deals with all of your items that are to be paid as part of the lending transaction. So typically you'll have loan origination fees, application fees, processing fee, underwriting fees, broker fees, compensation. But with Iberia Bank, we only charge the one flat fee, which is a lender administration fee of $11.95. Some companies, when you look at them, you also have to take into the fact they may not group their fees all together. They may split them out to make them look less than stellar or make them look beautiful to you. But you do have to keep that in mind. That section you do want to look at, $11.95. That is a cost that's above and beyond the purchase of the home. Then you come down to the section where it talks about appraisal fee, which is the left column, which we're looking at to the far left, and you have your appraisal fees. Those are outside third-party service fees that the lender orders the appraisal through what's called an appraisal management service company. Appraisers will receive this information and they'll do like what's a bid acceptance. And bid acceptance means you may have a pool of 5 appraisers. They got to look at their workload, see when they can get this back to the lender. And they have service level agreements to where the expectation is already set. We want this back no later than 5 days after you accept the bid offering. Of course, guess what? They're going to do their research before they actually accept the bid. And in addition to that, they anticipate as soon as they accept the bid to receive their payment. So in a lot of instances, you'll see lenders ask for a credit card form to be filled out up front. The reason being is once we're ready for that appraisal and it gets accepted, we want to move on this as quickly as possible, okay? If there's a final inspection fee, of course, that typically happens whenever there's major issues with the home. The appraiser may need to go back out there and look at the home, or if there's a certificate of occupancy, a newly constructed home, and it didn't quite have the certificate of occupancy issued when the appraiser went out there, he's going to have to do another trip. Any additional trips, that $150 inspection fee covers that as well, okay? And then, Antoinette, you did a fabulous job on the settlement and closing cost fees, so I'm not going to touch on that. But typically, you'll get a statement that outlines and breaks down these costs, and it's called a closing disclosure. That's typically what you will receive as a closing disclosure, and it have a breakdown of all of these costs in addition to what you may have to bring to the table. Okay, next slide. Let's see what the next slide says. So this just gives you a little bit of information. Now, one thing is every property has to be insured. So there has to be an insurance quote. Do not pay for insurance. If you're purchasing a home, do not pay for the insurance up front or out of pocket. It is considered as part of your closing costs, okay? So the lenders, when they establish what's called an escrow account, which incorporates paying your insurance and property taxes annually, so no liens or judgments get levied against the property, that's what an escrow account is there for. So the lender will put that cushion aside up front in advance so that within your monthly payments, you're paying the property taxes and insurance all along. So annually in November, when property taxes are due to the county, they're paid here to the county. And when your insurance policy comes due, the annual payment is sent off. You don't have to worry about paying that separately, okay? And that's where, that's in the estimated reserve and prepaid closing cost section. That's where you're going to see that at. Now, of course, when the insurance company issues a brand new insurance quote, they anticipate at closing, they're going to get the full annual amount up front, 12 months. So that's why the lender has to put that cushion aside. So that could add to your closing costs, but it's not a major situation. What happens is if you're eligible for grant funds, assistance, or any types of credits, all of that will be deducted on this transaction summary section as a credit or benefit to you. Okay, next slide.
Okay, this is the second case study. I just saw in the chat that you guys didn't get to see the pictures of the other property. And that would be operator error because I was not sharing the proper screen. And I know we're over time also from the delay. So let me do this. Let me just jump back to the photos of that one. And we can then go ahead to the questions. I think, Adrian, since this is just another scenario, we can skip over this one.
Okay, sounds good.
Okay, give me 1 second, and I want to be able to show you guys those photos from the other property. And those of you that have typed in questions, we will get to those in just a second. As I said, or as Denise mentioned, we're saving all the questions for the end. I see questions in the Q&A, and then we also have some questions in the chat. I've taken note of those, and I will. I'll review those in just a moment. Okay, I'm pulling this up. Share my screen, share the property. Okay, this is the property. Sorry about that. 548 Burn Drive in the Rock Lake neighborhood. The renovated home, 3 bedrooms, 2 bathrooms, just about 1,800 square feet for $249. Good quality. This is going to be on par with what you're going to see in this area for renovated homes. You're going to have the granite stone countertops of some kind, usually redone the hardwood floors, fresh paint, fresh cabinets, and good looking kitchens and bathrooms. Okay. And I still have music playing. Got it. Okay, so now I believe we're ready for Q&A. Adrian, anything else you wanted to add before we get to the questions?
Oh, let's hop right into them. I'm ready.
Okay, I'm going to start with those that were asked in the Q&A feature. Ashley Ward asked, if you accept credit card offers from Credit Karma, can you cancel the card before you activate and you're charged the annual fee, or would it negatively affect your credit history and score already? You have an answer for that?
That one is the answer to that one is one you've already had. If you've already had them pull your credit, it could negatively impact you because it's new. You had them pull your credit, you extended the credit debt, and until it actually updates to the credit bureau, so it could impact you. But for more information, I would have to refer you over to a credit counselor for that one. Okay. Okay,
thank you, Ashley, for that question. Next question is from Regina, she asked if your down payment is larger. So for example, with the Home Ready, you showed us that payment was 3% down. If you're making more than 3% down, would that make your monthly payment smaller?
That is correct. Great question there. It will make your monthly payments smaller, because what you're doing is you're reducing the amount of loan that we're going to take out, and that we're going to leverage the interest rate and payments across over. Okay, so yes, it will.
Okay, thank you
And
for
it could
that
also
question.
lower your interest rate as well.
Sorry.
I was going to say also, the more that you put into the loan itself, now you're putting skin in the game, equity. So the lenders like that, and it could potentially, depending on the amount that you put in there, could reduce also your interest rate as well.
Okay, Michelle, I think that's Michelle or Michelle. What is the best way to increase your credit score?
Okay, I know I touched on this briefly. So you got a pen and paper. I'm noticing that, well, I've noticed this for quite some time. It's called self-reporting. Some individuals have started self-reporting their cell phone bills or either utility bills to Experian. You can go on Experian.com. It's called Experian Boost. It is a special feature that Experian offers to be able to do self-reporting. And what you will do is this is all through their website, through filling out their forms, and it is a consumer eligible opportunity that you have to be able to self-report what your payment history is from your actual utility bill or mobile companies. That's one avenue. Another avenue is to make for sure that if you do have credit debt out there and you have payments, look at your balance and see how much your monthly payments represents of that balance. If it's less than 10% or less than 20%, typically it's an improvement. You'll see your credit score start to improve. Now, keep in mind, there are certain medical collections that are out there. You want to make for sure that you monitor your credit report periodically. So a couple of websites that you can go to for free credit reports is annualcreditreport.com. That's annualcreditreport.com, or either go to freecreditreport.com. It's much, much better. There right now during COVID-19, they are offering free services on a quarterly basis to monitor your credit.
Okay, thank you, Michelle, for that question. Next question. Deborah Jennings asked for some insight on for individuals who may be disabled on limited income who cannot work. Is there something they can do to cover, or if there's something that you can do to cover payments if you are deemed disabled? Let's say if you already had a mortgage, I guess she's asking. If you get a mortgage and then become disabled, or if you're a disabled individual before starting your home buying journey, what options might there be for someone in that situation?
They would have to reach out to the Orange County Housing for that type of information. I'm more knowledgeable about the residential lending side, and I don't want to misdirect you in regards to receiving that type of assistance. But Orange County Housing does have a website where they will work with those individuals who are receiving disability benefits or disabled and having some challenges with their current mortgage.
Okay, Deborah, I hope that was helpful. Denise or Trish, you might have to help me out. Or even Adrian, I do not have the questions that were entered at the beginning of the session because I left the room and came back in.
Oh, okay. I have those. Okay. I've answered some.
Yes, they've been answered.
Some were the ones that are answered or not answered. Well,
yeah,
let's go ahead
and that don't have the answer since you typed them.
Okay. Oh, okay, good. So my lease ends at the beginning of March, and how far in advance should I start the search? Once again, you want to start that as soon as possible. The reason being is you want to know the overall financial snapshot of your situation. And the best way to start is, one, gather your documents together. Two, know where your credit score is, and have an idea as far as what's on your credit report. And right now, more than ever, you want to start pulling those free credit reports if at all possible, so you can keep a track on it. And once you put that together, come see a credit counselor, or either you can come and see if you pre-qualify, if your credit score is high enough for a potential loan to start the home buying process. And then we'll work in hand with realtors such as Antoinette to be able to get you into the home. Good question. Good question. Do you have to buy in a rural area to qualify for a USDA loan? No, you do not. Okay. There are communities that are being built out in Polk County, Lake County, or areas that are zoned for agricultural or rural, but they may be like subdivisions that have been created by certain builders. You can qualify for a USDA loan as long as it falls in that particular zoning or market area. Okay, good question. Good question. Is it possible that it will come out? Is it possible that it will come out of retirement anytime soon?
She was referring to the programs that used to be no money down, like you talked about, that are gone.
Oh, okay. Yeah. Oh, the ones that were retired. Yeah. No, I do not foresee those coming back at anytime soon. And with most mortgage lenders like myself, we're on calls constantly throughout the day. Even though we're helping clients out, sometimes we get pulled into conferences for periodic updates on what's changing within the organization or what's changing in the market overall. So no, those will not be coming out of retirement based on the heavy regulations by what's called the Consumer Financial Protection Bureau, which is a federally regulated oversight committee that watches and monitors these banks out there. Okay. Good question. Good questions. Keep them coming. How long would I have to be on the job to qualify for a mortgage? Okay. So if you were a full-time student in school, okay, full-time student, you can provide full-time transcripts, and then you go into the workforce, at least you want to be in that workforce for at least 6 months to a year, and provide, it will have to obtain what's called a verification of employment along with your offer letter. But we can couple that together. The rule of thumb is 2 years you need to be gainfully employed because we're going to ask for 2 years of tax information, 2 years of W-2s, pay stubs. Pay stubs have to be within the last 30 days. One little caveat I do want to toss out there to many individuals: if you have been furloughed from your job and have placed certain installment loans or debt obligations in forbearance, getting a loan with those being in forbearance is going to be almost impossible. And I'm just letting you know that with the COVID-19, lenders have cracked down on that. The only reason why they're doing that is they can't anticipate whether or not you'll come out of forbearance or if you're going to go into a mortgage and put that in forbearance as well. So they want to make sure that you're out of the forbearance, it's been satisfied, and also that you've made 90 days of consecutive payments towards that obligation that was in forbearance. That's just a little information that not too many people are aware of out there, but they need to be aware of it moving forward until we get over COVID-19. Can you apply as a first-time home buyer 3 years after a purchase if you are still on the mortgage? Once again, you're on that title. No, you would not be classified as a first-time home buyer. You would be classified as a regular home buyer. In many instances, I had one client come to me and she co-signed for her mom, and she's young, and now she wants to buy her own house. She can't be classified as a first-time home buyer because she's on her mom's mortgage. And her mom can't refinance because she just got the mortgage last year. Okay. Any advantages for full-time student? Full-time students, there are not, unless you're in a medical profession, a doctor. If you're a full-time student and you're in a residency at this point in time, then you potentially could qualify for a doctor loan program. But they do want to see that you do have employment because your employment has to show that it's going to be continuous for a minimum of 3 years. Okay, good question there. This pre-approval letter give you an estimated amount of how much you qualify for? Yes, it does. So on the pre-approval letter, you'll see two amounts. You'll see one that shows the purchase price amount and one that actually shows the loan amount. All pre-approval letters should show those two items on there. The pre-approval amount is how much you qualify for. That will be the purchase amount. On my letters, I like to highlight that section. Now, keep in mind that that is subject to change. We give a rough estimate. And in many cases, my first question is what is your comfort level? Because you may be able to qualify for a whole lot of house, but we don't want to put you in a predicament that makes you feel uncomfortable. We want you to enjoy that first home ownership, okay? So always, that's the first question that should be asked to you is what is your comfort level? Because a lot of times people ask, how much do I qualify for? You can qualify for $300,000, but you know what? Your comfort level is 200,000. So let's keep you there. And then if it's subject to change, things change over time, then just let us know and we'll update the pre-approval letter. Okay? Good questions. Good questions. What if you are a full-time student and for 18 months going back to the same field with a higher degree, but no working for 1 year? Okay. So that's a unique scenario there. There's a gap in employment. As long as we can prove that you were full-time and as long as it's in the same field, we'll need to obtain some sort of documentation, transcript showing you were a full-time student again, and prior, at least 2 years of employment history. So prior to going back to school for the higher education, as long as you have the year before tax information, we can get certain types of exceptions through our underwriting department or credit risk management. And underwriters, we call them credit risk because they're always trying to protect the bank. But good question, good question.
I think that's, we don't have any questions right now, but I wanted to just add a piece of information. I think earlier Adrian was talking about the order in which you need to carry out your pursuit of purchasing a home. And as a realtor, I get so many calls from people that may want to go see a property that they've seen online. They want to schedule a showing, or you know, they're ready to move forward. And I say, have you talked to a lender? Have you gotten a pre-approval, or have you gotten pre-qualification? They'll say, no, I'm going to wait and do that. I want to see the house because I really like it, and I know, you know, I just want to see it first, and then I'll talk to a lender. And I have to tell them every time, you're doing it backwards. You're absolutely doing it backwards. You need to speak to a lending professional first, someone like Adrian. They're going to run those financials for you and find out what your budget is. You don't need to go see houses that are $250,000, $300,000, $400,000 or whatever. And then at the end of the day, by the time you get your pre-approval letter, you're only pre-approved and comfortable with a mortgage for something that's $175,000. You wasted time. You wasted time and energy. So I just want to stress that. You can look on Zillow and Realtor.com all you want and check out houses. But when it's time to really get down to business and you think you're financially ready to take that next step, the first person you talk to is a financial professional, a mortgage loan officer like Adrian.
Thank you very much, Antoinette. Appreciate it. Okay.